But what we don't know is, does it add up to $60,000 plus 10% interest or a 10% return, which is what they said they want, right? A 10% return. So what I want you to do, I want some help because we need the factors. What percent are we using here, Tyler? 10. So can you check out that table? You all might want to kind of permanently put a thumb there or flip over a corner of a page or that table. We're going to be using those tables a bit today. What factor then do we need? 10% 1 year, Tyler. Give me the whole number. 9091. Okay. Evan, help me with that math. Whitney, what about 2 years, 10%? What number? Well, that's okay.
2 years, 10%?
Yes.
0.8264.
We're
going off the dollar due, right?
Huh?
Are we going off the dollar due or the annuity?
The top one, just the top one, the dollar dude. 8264. And then who's going to help me with the math there? JJ, you're on that math. And then Chris, 3 years, 10%. 0.7543? 13. And Kylie, if you could do that math. Math number one, Evan. $22,727.50. Say again, 22,000? And 50 cents. Beautiful. Who was next? JJ. You don't have your calculator. Where is your calculator? We've had this conversation before, and I bet it's on film. Where's your calculator? Heavens, it's only an accounting class. We never need a calculator in accounting class. Kristen, do you have it? Oh, she's going to go get her calculator now. Brett, do you have it? Please. That?
No, I mean like
20,000. Say it slower. 21,000.
42.
And 42 cents?
50 cents.
20,000, 42, and 50 cents? Ooh, a lot of disagreement. What do you think it should be?
Oh, okay, never mind, yeah. Yeah, I was
What?
I got 20,660.
Any pennies? Okay. And who's supposed to do the last one? Please.
$18,782.50.
And how much? 70 cents? 50 cents. Okay. And now what we need to do is add these all together and put them there. There's a lot of people missing here. Nicole, do you have it?
62,170.
As long as that's a positive number, we're happy. Because we use that 10% factor to calculate those other numbers that added up to this. And so we are happy, very happy, because we have a project that earns a 10% return over 3 years and even more. Okay? So we are happy. Yes, sir?
So how do they make this money?
What do you mean, how did?
Well, it's probably $25,000 in sales or.
Yeah, sales or, yeah, it's actually profit. It's cash flows, technically. You know, however, you know, or yes. Well, but they're expecting to, right? Why would you, if you got $60,000, who's involved in one of those little trinket selling companies? I know Chance is. Who else? Or not Chance, but the old boy at the end. Yeah, and so what are you all selling? Are you water bottles company too? What are you selling? Sweatbands. So we've got sweatbands, and are you on the sweatband? Sweatpants. So we've got sweatbands. Are you listening? If you spend $60,000 with this company, they're going to be making sweatbands, making and selling sweatbands. Okay. If you invest in this company, $60,000, you are making sweatpants. And if you are in this company, you're making and selling water bottles. Okay? If you invest $60,000 in this company, how are you getting your money back? Selling what? And for them? Which product? I named it. No, you weren't paying attention. Sweatbands for this particular. So you said sweatbands or sweatpants? Oh, bands. Then you were correct. Oh, what? And so you invest, so you sell lots, you hope they sell, if you want to invest in that company, you hope they sell lots and lots and lots of sweatbands, right? And then you get $25,000 a year back. Can they sell enough sweatbands to get $25,000 a year back? Can they sell enough sweatbands to get $25,000 a year back? They could. Which company do you think would be most likely?
Out of those three?
Yeah, those three. But see, that's how you would choose. But that's the decision you'd have to make. Yes, sir, Tyson.
But they're investing in equipment, not a company, so.
Yeah, in this case, the equipment would be lower operating expenses, potentially, right? If you buy a higher tech piece of equipment that's going to yield lower.
But wouldn't it be the $25,000? Is this $25,000 they're making? Like, I just don't understand, I guess.
What don't you understand? They're spending. They are spending money, but the concept is they are spending money because they're expecting a benefit. So and you don't have to kind of riddle through much more than that, really, in the sense of, they're expecting a benefit either in terms of additional sales and profits coming in, or in this case, we can buy a machine that would save money.
And it would save them $2,170.
No, it would save them $25,000 a year. And so all we care about this number is that because it's positive, because it's bigger than zero, that means we needed to earn $62,100. This project has to earn $62,170 in order to earn us a 10% return over 3 years. We've got even $2,000 more than that, so we're actually earning a return greater than 10%, and we're happy. And that's our decision. So our decision is yes, do this. We are happy. We're earning at least 10%, a 10% return over the course of 3 years by spending this money.
So your sales are 75,000, right?
Yes. But a sale 3 years from now isn't worth as much money as a sale this year, which is the whole time value of money thing. If you need a little help, unfortunately, we've got to make sure I get through all the problems. If you want to conceptually understand it a little better, and I'm not doing a really great job, which apparently I'm not, you might read through your textbook on this. Kind of the first couple of pages or first 4 or 5 pages of your textbook on the chapter and see if that is helpful.